Welcome to Real Estate 360 with real estate expert Kenn Renner. Kenn, good to see you again. Last time we spoke, you had some travel in front of you. I know you're doing some speaking engagements and just staying busy through the month of December and mixing that in with the holidays. And it's a busy time of year.
Yeah, it is. So we haven't seen each other in a while because we skipped December. I had my birthday turned 61, so
Congrats.
I've been 42 years in real estate. So
that's a career, man.
Yeah, that's 40,
you've seen
40.
some highs and lows.
Oh, yeah, we'll be talking about some highs and lows today.
What are we in now? A high or low?
It's a stable market.
Stable.
So that's good.
Okay.
Stable.
Yeah.
So
good.
yeah, stable is good.
Right.
Yeah, because all the news is behind the times. They're already talking about that Austin's still crashing and this and that.
Right.
That's not the case. We're going to prove it right here when we go over the stats.
You were going to, I believe it was Orlando, and speaking at a big conference, had over 2,000 people. Is that correct?
Yeah. Actually, it's a Tom Ferry coaching organization, and they had 2,200 of their elite, top tier coaches that were being trained all about AI and all about marketing and all kinds of different things that are just cutting edge and lifestyle stuff that really the higher volume agents get together in Orlando once a year to not only to learn but also to network, and that's what I did. I held a meetup, and we had about 45 people at our meetup there at the lobby at the Gaylord Hotel, and I did a short presentation on how they realtors, if they're not already investor experts or have that in their quiver, their back pocket, that they can become an investment expert too. Right. So I'm actually training other agents in other markets how to do what I do. And a lot of these people are in high equity markets, which are not really conducive to investment, like rent, like California has such horrible landlord-tenant laws. We talked about that, but so people are transferring, getting out of those not landlord-friendly states and going into places like us where we have very, very
it makes you wonder,
friendly.
when are places, you mentioned California, when are they going to wake up and go, a lot of people leaving here and they're taking their tax dollars with them.
Look at Elon. He picked up stakes, Standard Oil or Chevron just are moving 2,200 people out of Danville area to Houston.
Yeah.
So, I mean, and to be a landlord is even more difficult because it's actually, you can't even call them landlords in California. I learned from one of the agents out there. You are property providers.
Oh, okay.
Yes, yeah. We're a property provider. Right. And there are so many rules about having to evict. They just passed a law. You can't take a double deposit if they have bad credit and this and that. They're really taking the ownership property rights away from the landlords in.
Wow.
And it's really going to be an exodus of people getting out of those multifamily and stuff. And so that's where I'm on the cutting edge of coming out and helping those clients. I've got now access to agents and investments all over the United States. So if my market doesn't work, I've got a market for you. I just got off the phone with my Oklahoma provider. He's got 300 units that are working. He's also a developer. I've got a Florida developer that's all they do is build to rent units, and they're they'll do about 1,100 units a year. So I'm well connected with other agents and other brokers and other parts of the market where we can collaborate and share share what's good about our market. We'll share what's a little challenging, and so we learn from each other and network. And
networking's always good. It's not what you know, it's who you know. Sometimes.
So what's really cool is the guy from Scottsdale just referred me my first transaction this year, which happened to be a big deal, a 1.565.
Nice,
really beautiful house up in Crystal Falls. And so that's closing right next month. So I'm really excited about that.
Don't count your chickens before they hatch.
But see, it was referred by an agent, and he gets paid a good percentage.
Sure.
And there's that implied endorsement. So I love referrals going both ways. I love paying referrals out because I don't have any marketing dollars involved in that. And I love like receiving the mailbox money from referring out to other parts of the country where I just get a small percentage that I always name it a number because I'm endorsing somebody else.
Right.
So referrals are really big, and especially in real estate. And it's that insider knowledge. You got to have those that are well connected. And so many of my podcasts going back, we do talk to other agents that are in those markets and find out if it makes sense. Because each market has their own idiosyncrasies, the best and the worst. So. Let's get into stats, Sandy.
Kenn loves stats. Here we go.
Well, we got to go into stats. We're going to see, but we're going to disqualify the news. because it's behind a lot of times. So everybody has this perception that Austin's the sky is continuing to fall like Chicken Little. No, that's all over. We're pretty much stabilized market, and the stats will show it right here. So in December, the Austin Round Rock Metro, which is the 5-county area, had a median sales price of $450,000, and that was up 1.4% from last year. So not crazy.
Do you remember what the highest year it was?
Yeah, we're gonna get there in a second.
Okay.
So I've got a chart on that too. So and then 3.8 months of inventory. That's not bad at all. That's 6 months is considered equilibrium. And 80 days on the market. So you got to be patient. And you put your house on the market. You got to be competitive when you're competing against these builders that are offering this amazing financing. Also, the median price for the city of Austin is $575, which, believe it or not, is up 6.5% year over year from the previous year.
What do you attribute that to?
Well, possibly that there's more higher end homes that are selling, and there's been a pent up, all real estate in Austin. But I would say that maybe it's because some of the higher they'll bring the median up. But
Sure.
That's good news to see that the price is back to $575, the peak of the market. And take a look at this chart here. The peak of the market was June of 2022. And we're down about 19. We were down about 19%. Now we're back up another 5% or 6% or whatever it is. But back, and that was the absolute peak, and that was the 2022. But if you can look at it to 2019, we're from 2019 to 2022, it was doubled in value, 100% appreciation. That's not a healthy market, not sustainable, and of course that's exactly what happened. And we stopped doing a lot of the investing in 2021 in Austin. We were going to the submarkets because they were more stable and more affordable, better returns. And then it continued to go into 2022, and so we've lost about 19%. So if you bought in 19 or 20 or 21, you're doing fine. If you bought mid 2022, if you put 20% down, you might have lost your down payment. It's a hard conversation to have with my clients, and I've got them all the time coming to me. So we're being relocated. We bought our house at the peak. Yeah, well, you're going to either have to rent it out, or you're going to have to basically bite the bullet. And
that person probably had a pretty low interest rate too.
And that's what's nice about it, because if you have a low interest rate, you can do all kinds of things. You do subject to, you can do wraparounds. There's ways to preserve that low interest rate, and that's one of the.
But I'm just saying, going back into the market, the rates are a lot higher than it was.
Well, and that's the problem. You got the rates here. It is more of a normalish market. Really, honestly, back the last time it's been this high was in 2000 and 2004, actually 2002. Well, we were buying brand new houses in Avery Ranch for $175,000.
Yeah,
and we were paying 6.5% and weren't even blinking.
Yeah,
and those properties now are worth $700,000-800,000. So I mean, it's like it's all relative. So that was a normal range. When I got in real estate in 1983, rates were 12%, and that was down from 18%. Mm-hmm. So we had to learn all kinds of ways to do creative financing, and that's coming back around. Most of the realtors that hadn't been through the 07-08 crash, they have gone through that PTSD. If they haven't been through that, then they've never really experienced how tough it can get, especially with the rates. But the rates are causing a definitely affordability problem, keeping people on the sidelines. The bottom line, we're hearing a lot of news about there's way too much inventory being built. There's way too much builder inventory on the ground. That is partially true, only seasonally. Okay, because here's the bottom line. In Texas overall, we are 320,000 housing units short for what the population is demanding. Mm-hmm. Nationwide, depending on who you listen to, NAR or National Association of Realtors or Mortgage Banking Association, is between 4 and 6 million homes short. So what happened with the bust back in 06, 07, 08, that caused the builders to stop building. Mm-hmm. And it doesn't mean the population isn't growing, doesn't mean people are still moving here. It doesn't mean that. And so the bottom line is we are playing catch up, and we will be playing for a while. So there'll always be, especially for entry-level housing, there is going to be a market for the foreseeable future. And so we're basically buying the dip, especially in our investment markets, because where we're buying San Antonio and New Braunfels and these other sub-markets, we're getting it for half the median price of Austin. I mean, literally half. So you can drive 50 miles south and be 50% less. I mean, from a 550 market to a 250 market. Mm-hmm. So that's why these areas, because they not only are affordable, but they also have great lifestyle. So like New Braunfels, amazing town, poster child, it's a small town, vibrant, you know, but it still has that small town feel.
But I think I read it's also like, isn't it the most fastest growing one of them in
Yeah,
Texas?
so it is. It's the New Braunfels area and Georgetown where I live.
Yeah.
Those were on the Georgetown was 1 or 2, and New Braunfels was 4 or 5. So it was still in the top 5.
Yeah.
And reason we say that is New Braunfels and Georgetown are very similar because they are the nice small town suburbs of the big cities.
Mm-hmm.
Like Georgetown is Austin's cool little city north. That's it's fast growing, but it's vibrant, but it still has small town feel. Same with New Braunfels.
Yeah.
And the big thing in New Braunfels is Mayfair. That's the biggest thing that's ever hit New Braunfels.
Mayfair.
I mean, Mayfair is the newest master plan community. There's going to be 6,000 housing units. Most of them are starting on the 400,000s, going up over 900,000. Straddles both sides of I-35, just on the northern border of the city limits of New Braunfels. So it's 3 minutes into Creekside Crossing, which is every possible store that you can be in. Buc-ee's is there, and H-E-B Plus is there. Just every store you could possibly imagine. Huge mall. And so it's just 3 minutes from there. And they just announced that they're going to build a Costco adjacent to the community.
Oh.
So Costco does their research.
Yeah.
So I follow the Costcos, I follow the Home Depots, I even follow the Starbucks. Where are they building? Because they've done all their homework for us on where the demographics are.
New Costco also coming to Liberty Hill.
Oh yeah, right down the street in Santa Rita Ranch. So I compare Mayfair to my Santa Rita Ranch, the largest master plan community, actually 8,800 homes. That's where I live. But here's the kicker: we're able to buy right adjacent to the community are single family homes that are between the 200 and 250. That are literally, you can see the Mayfair community from there. Mm-hmm. So what that does is just like buying right next an affordable community right next to Avery Ranch or Santa Rita Ranch when it was being developed. It just, the luxury side of things just pulled up that lower end market. So it's a great opportunity to get in these areas and it's really 6,000 units. It's going to have 3 schools, 2 elementaries and a middle school on site. And those are 2 of them already being built. And then it's going to have its own town center, parks, recreation, 2,200 acres in total. It's just really going to be a real winner, and it's going to bring our more affordable housing, which is right next to it. They get the same amenities, the benefits, and everything like that. So I'm also once again working with other markets because there are opportunities for that kind of match what we're doing here. Like I just got off with my Oklahoma provider. He's got about 300. He's developing over 100 units himself, and he's got other builders about 300 or 400 homes that has available. And he's well networked, and he's a mortgage company owner, or vice president, and I've worked with him for years. He bought a couple houses from me. So we've worked well together. So I do trust him, and that's the whole thing, is finding a provider that's trusted. And he's doing total turnkey, 3 years free property management. So that's kind of, and the prices there start at $155,000 for a single family. Duplexes around $300,000 in good school district areas. So those are the kind of things that I'm because I've really been good at finding really good pockets like New Braunfels and West San Antonio and Temple, Texas, and these other areas. I felt I would just network with other agents that do the same thing, and then start plugging my clients in if they want an alternative market. And so I really it was kind of fun to be out with the top agent in Orlando for Lennar Homes, and he's one of my partners now as far as a referral partner. Also looking at, I'm connected with one of the largest commercial brokerages in the United States. Actually, they're international, and met with that broker, and they've got products. So I'm starting to move into, if you want a single family or a multifamily, I've got it. I got you covered if you want to be in Central Texas. But if you want enterprise, if you have a group of people and they want 100 units or 200 units, I've got the access to that. I've got the way to find where they're at, who they're with, and so I'm starting to be able to help with the enterprise level. And so, a lot of our clients, maybe a lot of like the deep pockets in the Bay Area, they're like, in single family, it's good, but it's not worth my time.
Right.
I want something bigger scale. So I have it. Most of my clients are single family, just one after the other, and it does well for them. And I'll prove that. So, with this of course, I use this Mr. Bill. He's one of my clients that took his San Mateo house for. I've used
feel
this
like
on
I know
my-
Mr. Bill.
Mr. Bill. Yeah, he sold his San Mateo house for, at the time, as a few years ago, 2018, 2019, for $1.45. It was bringing in $3,300 a month. He turned it into nine single-family homes. Most of them were free and clear after he got done with it, and he went from the 3,500 gross to 13,000 gross, and now it's 17,000 gross. So he's financially set. And my favorite one is Andrea S. I call her Andrea S. because I don't want to tell her who she is, but she sold a fourplex in Huntington Beach back in the late 90s when I'd already moved here, but I still had connections. My wife was from Fountain Valley, Huntington Beach, and she said, I need to buy property here in Texas. I really want you to help me with finding a home. I've got this 1031 in tax deferred exchange. I don't know how I'm going to do it. I'm just got divorced. I don't have any money except what's in the fourplex that's coming out, and I have no job. I'm like, okay, well, we can make it happen.
Yeah.
So got together with the management at D.R. Horton, and I found 10 homes spread across the metro. We cherry picked them, and the way we did this, because she had a lot of money cash in the exchange, you have to reinvest it all. So we were able to buy the properties, the first set of properties, with all cash, which all of a sudden, then we got them leased up, which generated income, which created enough income for when she had to get the finance ones on 8, 9, and 10.
Right.
She had all those leases in place, which provided enough income to do it. So it was really kind of fun. And she wrote me this beautiful note on my Google business page, and she said, "Hope you had a Christmas. Ours sure was bright. Here's to a wonderful 2024. How time flies. I can't believe I'm approaching 25 years since you helped me find the beautiful home I am still living in. On top of that, you helped me find 10 rental houses, which were the absolute best gifts of my entire life. Here I was, recently divorced woman without a job, and yet somehow you made it possible for me to qualify to buy 10 brand new single-family homes. When I shared it with my ex-husband, who wasn't what he had accomplished, he asked me how he could do it, and he actually is in the mortgage business. I still shake my head today and wonder how you pulled off such an incredible miracle for me."
Nice.
So that's kind of I call it destiny changers, and I'm trying to get my investor agents to change their destiny and buy their own portfolios of property, like I've been doing for many years, and so I don't have to work so hard when I get up there. And also, but the destiny changers for somebody like Andrea or somebody like Mr. Bill, or even the first-time home buyers, just gives me a lot of satisfaction.
Yeah, that's nice when you get a reward like that for hard work and help someone out and change their life.
Yeah, well, thank you. So one last thing, one of the things that we did back in late October, early November, the election was happening. Everything kind of stopped. But I sent out 3 emails to my database about the builder's fiscal year end closing, which we now have a fiscal quarter coming up. So we've got some really good discounts, up to $40,000, $50,000 off with National Builder, and then 5.25% interest rate. That was all great. And so when I sent that out, we had a lot of activity, especially right after the election, but they all had to close in November. I had 12 properties. We all closed them on November. It closed like a charm, but then I'm like going, that's awesome. We got 12 closings, but now we have 12 vacancies. Mm-hmm. So, and that's in December, in the worst time, right? So I said, okay, I'm going to use my marketing savvy, and we're going to make this happen between me and the leasing agents and all that. We did open houses on these houses every weekend. I paid agent to sit out there to make sure that they were available so they could get into them. We did Facebook posts on all the local moving groups and everything. What's new to New Braunfels? What's new to San Antonio? How to rent? We did a mass mailer into apartment complexes, and then this was kind of a fun one. I was going to be basically, you couldn't get into New Braunfels without seeing my signs. I put out 100. Our team put out 150 of these signs. So we had 1,100 hits on the website the first 5 days or over the Thanksgiving, and we got all 12 of them leased. All of them leased within 45 days. All 12. So they're all taken care of.
Marketing works.
Well, I got a love letter from the city of New Braunfels, and they said, This is a misdemeanor, and it's also $1,000 fine per sign. And I was like going, okay, oops, sorry. Let me humble myself. So I called the code lady, and she was really nice. She goes, oh, we know business owners come in, they don't know the rules. And so don't worry about it. We've already picked up all the signs, because I was going to go get them all, right? And don't worry, you picked up all the signs. Just don't do it again. I'm like, okay, thank you very much. So cost of doing business. But yes, I don't mind being a guerrilla marketer. That's what, and pushing the limits a little bit, but still got to play by the rules. Sandy, good to see you. Glad we could both be destiny changers.
Exactly. I'm waiting to do that for somebody. It's good seeing you.
All right, see ya.